What are debentures? Explain. Should you invest in debentures or FD? Debentures are debt instruments issued by corporations, companies, or institutions to raise capital from investors. When you invest in a debenture, you are essentially lending money to the issuer in exchange for regular interest payments and the repayment of the principal amount at the end of the debenture's term. Unlike shares, debentures do not provide ownership in the company. Instead, they represent a loan from the investor to the issuer. Debentures can be either secured or unsecured. Secured debentures, these are backed by specific assets of the issuing company. In case of default, the assets can be sold to repay debenture holders. Unsecured debentures, also known as naked debentures, these are not backed by specific assets. If the issuer defaults, the debenture holders are treated as general creditors. Now, let's consider the choice between investing in debentures or fixed deposits, FD. Investing in debentures. Potential returns. Debentures generally offer higher interest rates compared to traditional fixed deposits, which can potentially lead to higher returns on investment. Risk and return. The risk associated with debentures depends on the issuer's creditworthiness. Higher returns may come with higher risk, especially for debentures from less creditworthy issuers. Liquidity. Debentures might be less liquid than fixed deposits, as they may have longer tenures and a smaller secondary market. Diversification. Investing in a mix of debentures and other assets can help diversify your investment portfolio and manage risk. Investing in fixed deposits. Safety. Fixed deposits are considered relatively safe, especially when invested in reputable banks. They are usually insured up to a certain amount by deposit insurance schemes. Fixed returns. Fixed deposits provide predictable and fixed interest rates throughout the investment tenure. Liquidity. Fixed deposits are generally more liquid than debentures. Most banks allow you to prematurely withdraw your fixed deposit, although there might be penalties. Simplicity. Fixed deposits are straightforward to understand and simple to invest in. The decision between investing in debentures or fixed deposits depends on your risk tolerance, investment goals, and the current financial landscape. If you are seeking potentially higher returns and are comfortable with some level of risk, debentures might be suitable. However, if safety, predictability, and liquidity are your priorities, fixed deposits could be a better choice. As with any financial decision, it's wise to consider your individual financial situation and possibly consult with a financial advisor before making a choice. What is the diff between bonds and debentures? Bonds and debentures are both debt instruments used by organizations to raise capital, but they have some key differences. Nature of issuer. Bonds are often issued by government entities or corporations. Debentures are typically issued by corporations and companies. Collateral. Bonds can be backed by specific assets of the issuer or may be unsecured. Debentures can also be secured, backed by specific assets, or unsecured. Priority in repayment. In case of bankruptcy or liquidation, bondholders have a higher priority in repayment compared to debenture holders. Secured bonds and debentures have priority over unsecured ones. Ownership and voting rights. Bonds do not provide ownership in the issuing entity and do not carry voting rights. Debentures, like bonds, do not provide ownership, but certain convertible debentures may have an option to be converted into equity shares of the issuing company. Interest payments. Bonds pay periodic interest payments known as coupon payments. Debentures also pay periodic interest payments, but the terms can vary based on the type of debenture. Issuer type. Bonds are often issued by government bodies, government bonds, or corporations, corporate bonds. Debentures are primarily issued by corporations and companies. Marketability and liquidity. Bonds, especially government bonds, tend to be more liquid and easily tradable in the secondary market. Debentures can have varying levels of liquidity, and their marketability might depend on the issuer's creditworthiness. Usage and purpose. Bonds can serve as a method for governments and corporations to raise capital for various purposes. Debentures are typically used by companies to raise funds for business operations, expansion, or other financial needs. Regulation. Both bonds and debentures may be subject to regulatory guidelines and oversight, depending on the jurisdiction and type of issuer. Convertible feature. Some debentures may have a convertible feature, allowing the holder to convert them into equity shares of the issuing company after a certain period. This feature is not typically found in bonds. While bonds and debentures share similarities as debt instruments, the differences lie in their issuer type, priority in repayment, collateral, and other features. When considering investment options, it's important to understand these distinctions to make informed decisions based on your financial goals and risk tolerance.